Would it surprise you to learn that China, the second largest economy in the world, is facing an economic downfall of historic proportions? Let's take a closer look at what's happening. China's economy, once a robust powerhouse, is now showing signs of significant distress. The property sector, a critical pillar of China's economy, is in a state of crisis. The recent troubles of the property giant, China Evergrande, for instance, have sent shockwaves through the market. The company's inability to meet its financial obligations has not only raised concerns about its own future, but also cast a long shadow over the entire Chinese property sector. But the property sector isn't the only area of concern. The commodities trade, another cornerstone of China's economy, is also feeling the pinch. Countries that rely heavily on exporting key metals to China, such as Chile, Australia, and Peru, are feeling the heat as China's demand for these commodities cools off. To make matters worse, foreign direct investment in China has taken a nosedive. In the second quarter of 2022, it plummeted by a staggering 95%. This sharp decline is a clear sign that international confidence in China's economy is waning. So, what's causing this economic turmoil? Some point to China's aggressive monetary policies, while others cite renewed trade tensions with the US. It's likely a combination of these and other factors. And while some experts remain optimistic, suggesting that China's economic outlook could improve if monetary policy remains loose, the reality on the ground tells a different story. Could this be the beginning of a global economic shift? It's too early to say, but one thing is clear. The unraveling of China's economy could have far-reaching implications. As we continue to monitor this situation, it's important to remember that in today's interconnected world, a ripple in one economy can become a wave in another. And right now, those ripples are starting to look more like a storm. China's economic plight does not exist in a vacuum. It has far-reaching implications for the global economy. As the world's second largest economy, China's economic health has a direct influence on the global market. What happens in Beijing doesn't stay in Beijing. Let's delve into this. The potential spillover effects of China's economic slowdown are profound. Countries heavily dependent on exporting key metals to China are in the firing line. We're talking about nations like Chile, Australia, and Peru. Countries that have built their economies around the insatiable demand from the Chinese manufacturing sector. Now, imagine a scenario where this demand dwindles. These countries would face significant economic challenges. Reduced demand from China could lead to falling prices for these key metals, a blow to these nations' economies. The ripple effects would extend to the everyday lives of people, from miners to shopkeepers. But the impact doesn't stop there. Let's turn our eyes to the United States. The U.S. is one of the top 5 countries with foreign direct investment exposure in China. What does this mean? It means that U.S.-based companies with operations in China could face negative repercussions. We're talking about a potential decrease in worldwide profits and a possible downturn in the stock market. Let's not forget that total foreign direct investment in China has already plunged by 95% in the second quarter of 2022. This is a clear indication of the increasing wariness of foreign investors. In a world as interconnected as ours, an economic slowdown in one country doesn't just impact that country, it sends shockwaves through the global economy. Countries, companies, and individuals all feel the tremors. China's economic downturn isn't just a Chinese problem, it's a global issue. The ripple effects of China's economic downfall will be felt around the world. Trade relations between the U.S. and China have been strained, adding another layer of complexity to the economic situation. The ebb and flow of commerce between these two global giants has seen its share of highs and lows, but recent tensions have cast a long shadow over the economic landscape. Let's delve into this intricate web. The U.S., under the stewardship of its top trade negotiator, Catherine Tai, has been urging China to cease state subsidies in certain industries. This move, while aimed at leveling the playing field, has not been well received by the Chinese administration, leading to a stalemate that neither side seems willing to break. Now let's throw commodities into this mix. The commodities trade, specifically key metals, is a crucial cog in the wheel of global economics. Countries like Chile, Australia, and Peru heavily rely on exporting these metals to China. But with China's economy slowing down, the demand for these resources is likely to dwindle, leaving these countries vulnerable to economic aftershocks. The US, too, is not immune to these tremors. It ranks among the top 5 countries with significant foreign direct investment exposure in China. This means that American companies operating in China are likely to see a downturn in their worldwide profits and stock market performance. The second quarter of 2022 already saw foreign direct investment in China plummet by a staggering 95%. However, it's not all doom and gloom. Some market strategists, like those at Morgan Stanley, are optimistic that China's economic outlook could improve if its monetary policy remains loose. But until then, the uncertainty continues to loom large. Trade tension between these economic powerhouses adds fuel to the fire of economic instability. The global economy, already reeling from the effects of the pandemic, now finds itself caught in the crossfire of this economic standoff. As we navigate these choppy waters, one thing remains clear. The world is closely watching how this US-China trade relationship unfolds. The financial markets are a mirror reflecting the world's economic health. What do they reveal about China's economic downfall? In the face of China's economic turmoil, global equity markets have experienced substantial fluctuations. The MSCI Asia-Pacific Index, which tracks the performance of some of the largest companies across 11 Asia-Pacific countries, fell by 0.3%, marking its first quarterly fall in 6 quarters. Looking at the Hang Seng Index, a barometer of Hong Kong's market performance, we saw a significant decrease of 1.9%. Japan's Nikkei also took a hit with a decline of 1.4%. These downward trends are clear indicators of the market's reaction to China's economic situation. The oil market has also felt the tremors of China's financial instability. Oil prices have surged to multi-year highs. This is partly due to the decision by the Organization of Petroleum, exporting countries and allies to maintain their current output policy. But the uncertainty surrounding China's economy has undoubtedly added fuel to the fire, causing prices to skyrocket even further. Meanwhile, the US dollar, often seen as a safe haven during times of economic uncertainty, has weakened. This is likely a response to a combination of factors, including stalled talks in Congress, rising inflation, and renewed US-China trade tensions. As investors around the world grapple with these developments, they are becoming increasingly cautious, leading to a dip in the value of the dollar. The financial markets are not just abstract numbers on a screen, they are a reflection of investor sentiment, economic confidence, and global stability. As such, their response to China's economic downfall paints a telling picture. The markets have spoken, and the message is clear. China's economic downfall is a cause for concern. As we gaze into the economic crystal ball, what does the future hold for China and the global economy? Predictions and outlooks vary significantly across the board. Top economists such as David Rosenberg and Atakan Bakiskan warn of a potential economic crisis. They caution that the slowdown of China's economy could have a larger impact on the global economy than previously anticipated. This could particularly affect the commodities trade, with countries that heavily rely on exporting key metals to China, like Chile, Australia, and Peru, at the highest risk. On the other hand, some financial institutions offer a glimmer of hope. Despite the alarms of an economic downturn, strategists at Morgan Stanley suggest that China's economic outlook could improve if monetary policies remain loose. They argue that this approach may help stimulate the economy and mitigate the impact of the current slowdown. However, the long-term implications for the global economy are still largely uncertain. The US, being among the top 5 countries with foreign direct investment exposure in China, could see negative repercussions on worldwide profits and the stock market. This scenario could ripple through the world economy, affecting nations far beyond the US and China. In the midst of these varied predictions, one common thread emerges. The future of the global economy is closely tied to the economic journey of China. As China navigates this economic downturn, the world watches with bated breath, fully aware of the potential for far-reaching impacts. While the future remains uncertain, one thing is clear: the world is closely watching China's economic journey. As we continue to monitor these developments, it's crucial to remember that the global economy is a complex web of interdependencies. The economic downfall of a single nation can have a domino effect, impacting economies worldwide. As we look to the future, we must be prepared for the unexpected and remain resilient in the face of uncertainty.